All right, let's jump right into this visual explainer. Today, we're unpacking the sheer brilliance of Benjamin Graham's The Intelligent Investor. Now, this is essentially the 70-year-old market Bible, the exact foundation that taught legends like Warren Buffett how to build lasting wealth. It's a dense, highly concentrated masterpiece, but today, we're going to break down its most powerful, actionable lessons on exactly how to beat the market.
So, here is our roadmap for today. We'll cover beating Mr. Market, the investor versus the speculator, protecting your capital, avoiding the IPO trap, mastering the margin of safety, and finally, understanding market history.
To really grasp the weight of these ideas, just remember that Warren Buffett, literally one of the wealthiest people on the planet, considers Benjamin Graham his ultimate guru. In fact, Buffett was so incredibly inspired by Graham's philosophy that he physically tracked him down at Columbia University just to become his student. Buffett credits his entire wealth-building journey to the exact principles we're about to explore.
Section 1. How to beat Mr. Market by simply ignoring his wild mood swings.
Picture this. You've got this highly emotional, completely unpredictable business partner, and his name is Mr. Market. When Mr. Market is in a fantastic, optimistic mood, he knocks on your door and tries to sell you stocks at outrageously high prices. But when he's depressed and the world looks grim, he panics, offering to sell you his shares for absolute pennies. Most people let his mood dictate their own, right? They get happy when he's happy, they panic when he panics. But your winning move here? Completely ignore his emotions. Do the exact opposite. You've got to control your own greed and fear. When he's irrationally happy, you sell. And when he's deeply depressed, that is when you buy.
Moving on to Section 2, the investor versus the speculator. Which one are you?
Now, a true intelligent investor plays the long game. We're talking years here, not just days or a few months. They strictly use their own spare cash, meaning their daily life is never threatened by a market dip. And most importantly, they do the deep fundamental homework on a company. On the flip side, let's look at the speculator. They basically treat the stock market like a casino. They want quick profits in a few days or weeks. They'll actually borrow money, sometimes even mortgaging their homes, and they buy based on hot tips or sheer excitement without doing any real research. The speculator is playing a dangerous game, and it inevitably leads right into a trap.
To actually beat Mr. Market, you have to adopt the mindset of an alert cat. Extremely cautious, constantly scanning for danger, and always ready to run. The speculator, however, they're like a blindfolded person walking straight into a bear trap. Careless, arrogant, entirely blinded by greed. They think they know the whole shebang and act purely on impulse. Winning this game absolutely requires you to be that cautious cat.
Section 3. Protecting your capital first. This is rule number 1.
Okay, the absolute bedrock rule of investing, and you've probably heard Warren Buffett echo this as rule number 1, never lose money, and rule number 2, never forget rule number 1, is that preserving your initial capital is way more important than chasing explosive, risky profits. Honestly, whether you're starting with $1 million or just 50 rupees, your primary job is to ensure that your starting baseline is completely shielded from permanent loss. Because think about it, if you lose your capital, you lose your ability to play the game entirely.
So, what does this actually look like in practice? Well, it's all about grounding your expectations. By diversifying their portfolio, a true investor isn't out there looking for a magical 30 or 40% return overnight. They're aiming for a highly sensible 5 to 10% return above inflation, or what they'd get sitting in a fixed bank deposit. This keeps the greed in check. It directly supports our core mission of safely beating the market over time, simply by stopping you from making wild, speculative bets that put your initial cash right in the crosshairs of Mr. Market's mood swings.
All right, Section 4. Avoiding the IPO trap, or how not to overpay.
Graham is super explicit about this one. Stay away from initial public offerings, or IPOs. See, normal shares that have been trading for years are priced naturally by market demand and supply. But an IPO, that price is set directly by the company owners and their merchant bankers. And human nature dictates that the owner naturally wants to charge you the absolute maximum price possible for their shares. Unless it's a truly exceptional, once-in-a-lifetime setup, the intelligent investor generally sidesteps IPOs because, frankly, the deck is heavily stacked against you from day one.
Which brings us to Section 5, the margin of safety. This is literally your ultimate armor. Let's look at how Japanese factories handle risk management. They use a very strict color code for their critical chemical reserves. Green means the stock is full, all good.
Red means the stock is low and they need to reorder immediately. But below the red, there is a black zone. This is a totally hidden reserve of chemicals that nobody touches unless it's an absolute code red emergency. It ensures the factory never ever stops running, even if a delivery gets severely delayed. That black zone, that is a pure margin of safety.
Honestly, you already use a margin of safety in your everyday life, right? Think about your car's gas gauge. When the needle hits empty and that light turns red, the car doesn't just instantly die on the highway. The engineers built in a margin of safety, letting it run another 50 to 70 kilometers. Or think about flying. You don't aim to arrive at the airport the exact minute the plane takes off. You get there 2 or 3 hours early, building a buffer just in case there's a traffic jam or a massive security line. You are actively protecting yourself from the unexpected.
So, taking that concept and applying it to your portfolio is the secret sauce here. You absolutely must calculate the actual intrinsic value of a company. If you determine a share's true value is 100 rupees, you do not buy it for 100 rupees, and you certainly don't buy it for 110. You wait for Mr. Market to get incredibly depressed, and you scoop it up at 80 or 90 rupees. That 10 or 20 rupee difference, that is your margin of safety. It absorbs the shock if your calculations were slightly off, or if the market suddenly takes a dive. It's your financial armor, built specifically to defeat Mr. Market.
Finally, Section 6. Market history always repeats, meaning crashes are inevitable.
Look, history proves time and time again that the market is going to have these massive, terrifying crashes. We saw it with the 2008 global financial crisis, we saw it with the 2020 pandemic crash, and during these times, the average speculator absolutely panics. They sell everything at a massive loss because Mr. Market is outside screaming that the world is ending. But the intelligent investor? They are that alert cat. They know that crashes are historically always followed by inevitable recoveries. So they step right in during the chaos and buy high-value, fundamentally strong assets at a massive discount, completely securing their long-term wealth.
So I want you to take a really hard look at your own portfolio today. Are you out there ruthlessly demanding a margin of safety, or are you secretly just gambling in Mr. Market's casino hoping you'll get lucky? Benjamin Graham laid out the definitive blueprint for wealth 70 years ago. The rules haven't changed, but the real question is, will you?